Good. Hi, and welcome to the Financial Fitness First Worldwide Wealth webinar for 2026. It is wonderful today to meet in a different environment to what we were expecting a few months ago. And it's so easy to forget that the 2025 year ended with South Africa experiencing a phenomenal year in the bond, equity, and property markets. As this year has begun, we were poised for a constructive 2026. Expectations of lower interest rates and inflation, a stronger rand, the first positive trade surplus in years, and by the end of February, a favorable budget. However, the recent oil shock and escalation in the Middle East has been a sharp reminder that market shocks don't arrive politely. They turn up uninvited, disrupt the calm, and rearrange the furniture. Since the 1st of March, the rand has weakened by around 5.5%, and the JSE All Shares down roughly 11%. In that context, it's important to distinguish between the noise and the fundamentals, and to remember that you are not navigating this alone. Our multi-asset portfolios have done what they were designed to do: cushion the blow. And over the past 18 days, our portfolios have ranged between negative 1.5% and 3.6%, which is a far cry from the JSE All Share Index. This range illustrates how different asset classes respond to a crisis, and it is exactly why diversification remains one of the most powerful tools to manage risk in times like these. So if we stand back and look over the long term, episodes like this appear as temporary disruptions rather than permanent losses. And many of you have been investing with us for more than a decade. Together, we've already navigated the global financial crisis, the pandemic, load shedding shocks, and multiple periods of political instability. Each time, staying anchored to sound principles has been more effective than trying to predict short-term outcomes. We cannot claim certainty about how this specific conflict or the oil price will evolve, and short-term predictions are usually a fool's game. What we can do, and what we will focus on today, is staying grounded in the fundamentals that have not disappeared because of this crisis. Some outcomes may be delayed, but the underlying drivers of long-term returns remain intact. So that is the heart of today's discussion. What fundamentals can be your calm in the storm, and how you can rely on facts and proven investment principles rather than headlines and hype. It is therefore a pleasure to introduce our speaker, Malcolm Charles. Malcolm has been a portfolio manager at 91 Asset Management since 2001 and is responsible for a range of fixed income portfolios. Over more than 2 decades, he has navigated multiple market cycles and geopolitical events. And he has an exceptional ability to cut through complexity and summarize what truly matters in the current environment. And he translates that into clear, practical implications for you, our investors. So, Malcolm, thank you for being with us today, and over to you.
Thanks very much, Vicky. Hi, everyone. Thanks for joining us at this time. As Vicky quite aptly put there, a slightly different environment to what we'd got used to over the last, call it 11, 12 months, where not only the world, but South Africa in particular was doing very, very well. We were in a pretty solid space, and sort of enjoying the benefits of it as well. So I thought it'd be worthwhile, just looking. Let's have a quick whiz around the world and around South African markets to see what we can expect. Can we make sense of the craziness that has fallen on us of the last, what's it, just over 3 weeks now. So it really has been a crazy time, and I would say probably mostly unexpected. So there was always a chance that something silly like this would happen, but the scale of what's happened in the Middle East has definitely taken, I think, the whole world by surprise. So I've yeah, my heading for today is the world has changed, but with that, our view has obviously changed as well. If we were talking a month ago, we would be in a very solid environment. As Vicky said, the budget was fantastic. Inflation was muted and under control around the world, and every central banker was either thinking of cutting interest rates or definitely keeping them on hold for the remainder of the year. That whole environment has changed, and we are in a environment where I think we can clearly say that every central banker is now data dependent, and they will react meeting to meeting. No one can predict how quickly this will come to an end, how long it will last. So you don't want to make panic decisions, whether you a fund manager, you're an investor, or a central banker. I think all of us need to look at this at the data in front of us and try and make a pragmatic decision for whatever money that we are investing at this time. So let's just have a look at what we've got, what we are working with. We've all become semi-experts on the Middle East. I think a lot of people now, most people who own a car and are facing big petrol increases next month suddenly know what the Strait of Hormuz is. 20% of the world's oil passes through there every single year. So a very, very strategic, a little bit of maritime waters, and also very easy to block. And we are seeing ships, not one or two going through, but very few going through there, and hence the oil price as we stand here today, Brent is ticking above around $115. We were at $65 a barrel a mere month ago. So a big change in the oil price, a lot of uncertainty, and then we saw the Israelis attacked that one gas field, and there was a counter attack on Oman. So it's got a little bit messy, and the outcome of the war now is a little bit uncertain and probably going to be a little bit more extended than we first thought. What is important, if you look on the right hand side, there is these are all the crises effectively that moved the oil price, going going back quite a number of years. And what we've looked at is 30 days after the crisis, what had happened to equity prices. So obviously the initial reaction in every single one of them is a sell-off. And then let's fast forward a month, which we are fast approaching. What can we expect? So the top two there, the Iraqi invasion of Kuwait in 1990 and the Russian event in 2008, both of those instances, as well as the 9/11 attack, equity markets had not recovered, and in the first two, they were still negative to the tune of about 6-7%. Negative. However, in every single other event, markets had initially sold off and then had started recovering. Operation Desert Storm, obviously, the big recovery, and markets were way up as people realized that the Allies were fast going to overthrow Saddam Hussein. So the message here is, if you had panicked and gone into cash in virtually every single crisis bar the top three, you would have locked in a loss and done quite badly on a 6 to 12 month view. So, I think calmness is needed at this time, and understand that in all the different portfolios, fund managers are putting hedges on. They have put hedges on in the portfolios to try and protect capital, minimize losses, and are looking to actively go back into the market when things calm down, or when it looks like things are going to stabilize. So it is there is no magic bullet that you can go. If you time clock, you can go back. By all means, sell all your assets and go into cash. But that is not. If history is to be repeated, that is not a wise decision to miss out on any recovery that comes through from there. So it really is a time, I think, to trust your advisors, trust the fund managers out there to take the right action, and to sort of set the scene of where are we as a country, where are we as South Africa, what are the fundamentals, how vulnerable are we? We are a price taker. We must always recognize that we're a small open economy. That's not really relevant in the world. Sometimes we get a bit carried away with how important we are, and if you read the press, you think everyone is stressing about what South African politicians are saying. No one really cares what our politicians say or do, because we are not a superpower that is changing dynamics. However, we have been doing quite a few things right, and as an investment destination, we have been a big attraction for foreign investors of late. They have recognized that we've done the right things, and both our equity market and bond market have done very well as a result, as foreigners have um, uh, realized that you can get very good returns out of our market. So, what have we done right? Inflation has been under control for a while. Our Reserve Bank continues to be probably one of the most pragmatic reserve banks in the world. Lesetja Kganyago and his team have done a fantastic job ensuring that the credibility of South Africa as an investment destination is sound. As a bond manager, I know that he's got my back. He will not let inflation get out of control. And that's always the first question I ask is, yes, we have these hiccups due to global events and everything like that. But as a bond manager, can I invest in the bond market knowing that inflation is not going to erode those returns, and I'm going to get negative real returns? I need to every single year deliver real returns and hope and obviously cash beating returns on top of that. And having a reserve bank with the credibility of the South African Reserve Bank is a wonderful position to be in. So we'll remember November last year, he convinced the finance minister to cut the inflation target from the 3 to 6 range to a midpoint of 3, a target of 3%, and we were well on track. Our inflation target for 2026 was going to be 3% on average for this year before this crisis. If you look at that table on the right-hand side there, you can see we've got various scenarios of the currency on the top and the oil price at the bottom. You can see none of us expected the oil price to be above 100, so it's not even on the table that we've got. But yesterday the inflation came out at 3%. It was a very good number. Core inflation very much under control. So the underlying dynamics of inflation in South Africa are very good. Yes, we are going to see a spike in petrol prices, and we estimate that it'll be about 5-6 rand a litre, the biggest increase that we've had in the country. Diesel price is going to go up over 8 rand a litre. So two big increases in fuel next month. So quick quick tip: make sure your cars are all chock-a-block full in the next week or two. You'll save quite a bit of money there. Um, but it means that we are going to see a spike in inflation. If you look on the left-hand side there, we were expecting 2 rate cuts minimum in 2026. We were expecting a rate cut next week. It was an absolute given. Inflation was under control. Expectations were down. The environment was completely supportive of that, and it would have been a no-brainer had this oil crisis not happened. What has now happened is the market's pulled back. We are no longer pricing in the rate cuts. We've actually priced in a small chance of a rate hike by December. That assumes that this crisis goes on. So it's a complete shift in the environment. So we need to be cautious. And as I said, we've put a lot of hedges in the portfolio to protect capital going forward. The Reserve Bank will every single meeting move from meeting to meeting. They're not going to try and preempt how long it goes on for. They will see and wait for second round effects of inflation. They're not going to react to the first round effect of petrol prices gone up, therefore inflation on fuel will bring a increase in the inflation rate. They will wait and see if people are passing on these increases and if food prices will start going up and normal goods and services. One thing to just realize is that the oil price is actually going to do some of the job for the Reserve Bank. It's going to take a lot of money out of disposable income, which normally interest rate hikes do. So it's unlikely to see inflation become entrenched in the economy. So I wouldn't panic too much about rate hikes at the moment, but it is a little bit more fluid than otherwise would have been. The really good news for the country has obviously been the move in gold and platinum prices. So platinum prices are down a little bit, as one would expect in a war like this, and an environment where disposable income is going to be less because people buy fewer cars. Well, the gold price, however, has stayed quite elevated. So you can see that on the graph on the left-hand side. On the right-hand side is our estimation of the extra money that the National Treasury is going to get through revenue from mining companies. And you can see, we got a decent chunk in the last fiscal year. In the fiscal year that starts next month, we estimate that we'll comfortably get between 70 and 80 billion rand more than National Treasury are even expecting. So they were very conservative in their budget, did not try and predict the gold price for the whole year. So they said, we're not going to put it in the numbers. So there's really good news for National Treasury going forward, and we should have a very good budget once again in February 2027. And what this will allow is further consolidation of our debt to GDP. So another really positive outcome for South Africa, even in these tough times. And something that we're not showing here because it hadn't really reacted yet is the coal price has started moving up again. As people start looking for substitutes for gas and oil, and we are big exporters of coal, so that number could even be greater if the coal price stays a little bit elevated for now. So it's not all doom and gloom. South Africa is bizarrely quite well placed in this crazy world, much better placed than we have been for the global financial crisis or the emerging market crisis. So we've had a couple of crises over the years. And this is probably the strongest we've gone into that crisis. So we will not be unaffected. Our markets are down and we will take a hit, but we are much better placed than we have been for a while. So what about the Rand? This you can see is a chart I look at every single morning. It's the trade weighted Rand against the US dollar exchange rate. And what the black line there is everything that we export divided by everything that we import. And when it was going up, what it meant was gold, platinum, everything that we export was going up. and oil was very low. So hence it was very supportive for the rand. You can see as what's happened now is the oil price has shot through the roof. So what's happened is our terms of trade have deteriorated because our imports have gone up substantially. But if you look at what the terms of trade are telling us, that the fair value, it's not like a complete collapse of the currency saying we must go back to 20 Rand to the dollar. It is saying fair value is still around between 1650 and 17 Rand. We're currently trading about 1690, so we're a little bit weaker than our terms of trade because the market is trying to preempt of where the oil price goes. Nothing abnormal about that. But once again, what it's showing you is that even on the up, we tracked our terms of trade. On the down, we track in the terms of trade. So, as long as the gold price stays where it is and platinum price behaves okay, it will offset some of the bad news of the oil price. So the rand is actually behaving very well. And if you compare it to all the emerging markets out there, it's actually done okay. We've performed in line with the way that we would have expected a normal crisis. Normally the rand is the one that just goes crazy. It is not because the fundamentals are so much stronger. And if you compare us to Europe and everything like that, we actually okay. It's really we've lost ground against the dollar because the dollar actually weakened so much over the last 12 months or so. So it's not all doom and gloom. We are not like the only country that's been affected. If anything, South Africa is faring reasonably well in this crazy time. So what can we expect from our bond market? Let's just reset of how did we go into this crisis? Let's understand, what foundation did we put in place last year? And the last year was actually a very good year for the country. S&P came and visited us. They gave us a ratings upgrade, the first upgrade in many, many years. Not only that, they kept us on a positive outlook. 2 days ago, I had a meeting with Moody's in our office, and you could see almost sad that they had to come in a time of crisis because their whole view on the country was starting to change, started to become more positive. Quite rightly, they need to now obviously temper, what they say and what they do. And I asked him at the end, what do you do in a time of crisis like this? And he says basically, for every country, they almost just pull back because they're not going to make a decision that will essentially take a 5-year view on something that they don't know if it'll end in 1 month or 3 months or 6 months. So everyone's in that wait and see mode. But we also got off the grey list a little bit quicker than most people thought. The turnaround in Eskom remains phenomenal. Not only have we got no load shedding, they turned a profit for the first time in many, many years, and we've actually got excess capacity on the grid, and more private generation capacity is coming onto the grid. So, we are now comfortably producing enough electricity for our current needs, and more importantly, for when we start growing at 2 and maybe 2.5% in the years to come. The ports are also showing a strong turnaround. Our rail traffic is up. Our ports are, if you just used Durban Harbour, ICTSI have now finally got the contract. They're starting to invest 11 billion Rand into the Durban port, which handles over 50% of all containers in and out of South Africa. The average waiting time in the Durban port has come down from 22 days that the ship sat out there to just 2 days. So it's a huge turnaround on that side. I've spoken about the commodity boom and as well as the inflation target change. All of those are just strengthening the potential for South Africa going forward. So bringing that all together of what can we expect? We've had 2 fantastic years in the South African bond market, 17% and 24%. But even if you go in the previous years, we were still getting, high 8s and 9% sort of returns in the bond market. And on the right-hand side there, you can see that sharp tick up. Now, you can look at that and go, oh, bond yields have sold off. Let's panic. But look how attractive that is. It's taking us back to sort of levels that we last saw in the final quarter of last year. Cash rates aren't going to change dramatically. Inflation, yes, it'll tick up a little bit, but you're still being compensated for that extra risk. You're still getting way more. The bond yield has gone higher than inflation and cash are going to go up. So your differential extra yield in the bond market will more than compensate for any change in that you sort of receive in or that cash and etc. will adjust by. So it's not going to turn around tomorrow. It's not going to turn around next week. But what this is giving us is an opportunity to sort of, if you take a 6 or maybe even 12-month view of returns in the market, it's actually quite exciting again now. Longer dated bonds are over 9.5%. That is a very, very attractive yield where that the Reserve Bank is going to get inflation back down towards 3%. So it's a very attractive environment. We're very confident that on a 12-month view, the bond market will be anchored by a Reserve Bank and National Treasury that are doing a very, very good job. And we are actually quite excited that this actually gives us an opportunity to take advantage of that in the weeks ahead when we get a little bit of clarity on the way forward. And then, this is just a chart that we added of, the importance of taking that opportunity that I spoke about earlier. Is you don't want to be sitting in a cash fund. So yes, you'll sleep well at night because you're not going to lose any money. It's just going to tick away. But unfortunately, inflation is also ticking away at that return. And if you in a fund like the 91 Diversified Income Fund, you're getting extra compensation all the time. And the difference that gives you over time is very, very material. And that compounding, people underestimate the importance of that compounding return. So it really is a time to don't panic. Perfect hindsight. Everyone should have panicked on the 27th of February. That doesn't happen. You don't get that. Trump's not going to send us a tweet and say, we're just going to cause the biggest problem in the world. What you've got to do now is understand that there are funds out there that have put hedges in place. They've protected some of the capital. They've increased the FX exposure in the portfolio. We've put a whole lot of option strategies that are protected in the sell-off. So there are many tools that we can use in the market to hedge against this craziness, but equally look for the opportunity when it comes through. So it is a crazy time, and we are going to see terrible headlines when the fuel price comes through and everything like that. But understand that the market is already forward-looking. The bond markets have already sold off accordingly. The interest rate expectations have already changed. They're not going to wait for the front page of the business day on the 1st of April when the number comes out. So those extra yields are already in the portfolio, compensating for that extra risk. So understand we've had these crises before. This too shall pass. And with that passing comes opportunity for the remainder of the year. So good luck out there. We hope we have managed to give you a little bit of insight into our thinking of how we try and protect the portfolio in this sort of environment, but equally, we're already looking ahead to say, is there opportunity and when is that opportunity going to come? Thank you very much.
Yeah, and well put. Thank you, Malcolm. I'd just like to emphasize the one point that Malcolm made with all of his data points, even though he's an income fund manager, those data points also apply to other asset classes and not just bonds. And most of our clients are going to have income funds in their portfolio at the moment. And so, just a question for you, Malcolm. With clients possibly drawing income from their income fund portion of their investments or holding it for shorter time periods, what would you say is the biggest risk to income funds for 2026 or at this point in time?
To be quite honest, Vic, I think we in slap bang in the middle of our biggest risk. I was actually asked this question. I think it was about the 15th of February, where I'd gone through, laid out what we expected for the year before. It's obviously a very different view of the world back then. Things were still solid around the world. Growth was ticking up around the world and everything like that. And it was the first time, I would say, in 15 years that my biggest risk, the thing that kept me awake, was not a South African risk. I am very comfortable with the path that South Africa is on. We are rebuilding, the foundations in place, the reforms are in place. Operation Vulindlela is steaming ahead, and as I mentioned, Reserve Bank and National Treasury have got their mojo, and they're really doing a good job. And my thing was the geopolitical risk. I said, unfortunately, we are a price taker. We've
Mm,
got no control of what happens there, and if there is a big global event, unfortunately, it'll hit everyone. And I think we are slap bang in the middle of that. It's this is the event that's going to change behavior of governments around the world, and we need to see how everyone navigates that. It is not a South African story, but this event is, we're going to look back at it like we do on the global financial crisis, like we do of the emerging market crisis of 2001. It's going to be a signpost in
in
all our
time.
lives. So yeah, we are living our biggest risk at the moment.
Okay. Well, that gives some sense of comfort at this stage, to know that we're better positioned for this crisis than possibly the ones that we were before, and that at least if we've got the fundamentals right and a conservative treasury, we've got a lot of factors pointing our way for better upside, even if it does come later than expected.
No,
So
absolutely. I mean, it's. I think that's the biggest takeaway from here is we will be well placed to recover quicker than we otherwise would have been in previous crises.
yeah.
We're not going to be trying to put out fires domestically when things turn. We can actually then pounce on opportunities.
And so as we close, to summarize everything that we've gone through in today's discussion, I just want to highlight that it doesn't matter whether this conflict, with the oil shock is resolved quickly or takes longer to play out. Our fund managers are all actively positioning themselves to navigate these risks and to take advantage of mispriced assets when they arise. So you don't need to time the market or react to all these headlines. It's been done in the background, with all of our different fund managers, and that is our job. And with that, I'd like to thank Malcolm for joining us today, and I'd like to thank everybody on the call for joining us today. As always, we are here to assist you with every aspect of your financial plan. And so please just reach out to your wealth planner if you want to discuss today's session or your own personal strategy. And it's some great news for financial fitness is that we'll be celebrating our 30th birthday next month officially. We'll be 30 years, and we've been through all kinds of markets, and our core objective has always remained the same, and that's to apply sound principles remain diversified, and it's been a cornerstone for all of our clients' success and in turn our own success to date. So we always look forward to engaging with you, and we'll see you for the next webinar in September. And until then, stay disciplined, stay diversified, and as Malcolm reiterated, keep calm and continue to grow your wealth. So thanks for joining us. Goodbye.